please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
You're with us here on a fresh new edition of Midcap Radar. The market's actually holding on, at least on the Nifty. 50-odd points on the Nifty is what we have. But as far as the broader market is concerned, there is, some weakness. The Midcap index is actually in the red. The Bank Nifty is down about 0.25%. An advanced decline is just a tad bit in favor of declines. You could have made the same complaint yesterday as well when you had that big 100-plus point rally in the Nifty, that the advanced decline was 1:1. Equal declines to advances on a day like yesterday. So, it doesn't surprise one that you're seeing a similar kind of picture today. 2 hours to go. Let's see if, the broader market picks up along with the Nifty, or the Nifty actually is pulled down a little bit by what's happening in the broader space. So, good afternoon.
Hi, Prashant. Good afternoon to you as well. So, let's get started. First up, our top stories. Well, record highs continue on Dalal Street. The Sensex and Nifty trade 0.5% higher, pulled up by heavyweights like Reliance, HDFC and Infosys. Big metal stocks like Hindalco and Vedanta top the Nifty charts.
Crude oil at $76 triggers profit booking in banking stocks. The Nifty Bank trades off the day's lows as inflation fears resurge.
Fertilizer stocks gain. Sources tell Network 18 that companies will now be paid subsidies every week instead of waiting for months earlier.
As the August 27th deadline for resolution of stressed assets ends, debt-ridden stocks continue to remain under pressure. NTPC, on the other hand, gains after Bank of America Merrill Lynch indicates that the company could be a beneficiary as it could be appointed to manage stressed power projects.
And Bharat Forge expects to clock revenues of 1,000 crores from the defense business alone over the next 2 years. Baba Kalyani tells CNBCTV18 they're creating capacity to build the largest artillery unit in the world.
All right, so let's bring in Ashwini. On that note, Ashwini, afternoon. Thanks very much. 50 on the Nifty. Your sense?
See, Nifty, you can say, is flattish. But I think, again, the macro fears are coming to the fore because the rupee is trading at the low of the day. And there's heavy selling on banks, particularly PSU banks. So if crude stays above 76 odd, rupee is above 70, 20, 25, then, financials get into a lot of problem. And today we've come off from very key levels, which are previous highs. So my sense is that another leg on the downside till the close is possible on financial. The market overall is pretty stretched. You've seen put-call ratio, etc. So if you have, macros deteriorating at this point, the correction is likely to set in just because of that. So I would take profits off on financials. We even have short positions now. And yes, Reliance is pulling us up, etc. But again, every day we are getting overstretched, and if banks pull out, just on the second day, then it will become a bit difficult for the market to keep heading higher, although, IT, pharma, etc. could work out. But overall, I would think that today something has changed for financials.
What would your trades be, Ashwini?
See, Sun TV is a buy with a stop of 770, target of 805. BOB is a sell with a stop of 147, target of 140. And Yes Bank is a sell with a stop of 375, target of 360.
All right, Ashwini, thanks very much for that. Let's also bring in some more market opinion. In fact, here's an important FII voice who was speaking to us on the sidelines of the Motilal Oswal Global Investor Conference earlier this morning. Joel Werner of Solitude Capital Management says that he's quite keen, actually, to look at the consumption space, but on the other side is not at all looking to make any investments in IT stocks.
The weakness in the rupee has been a pain. It's been, I would say, a little frustrating. I think the discussion around two things driving that, I think, would be the rebound in oil and tariff war. Because we're looking for companies that are compounding at such high rates of return on their capital employed, weakness in currency, again, we would expect somewhere between 4 to 5% depreciation in the rupee versus the dollar as we underwrite our investments. We had a large investment in IIFL. That did very well for us. especially the first half of 2016. We're still a large investor in that company for our fund. I think there's a great opportunity as that business separates into 3 separately listed operating companies. But our exposure to financials is really a byproduct of looking for asset management companies. So IFFL has one of the world's best asset management companies. We do not have any exposure to the Indian IT names. It's been a very challenged space for quite some time, and so we've been just kind of staying away from the fray. The IT sector is exciting, but most of that excitement, in my opinion, is in the private investing world, where we don't do any investing. You do look at a number of the consumer discretionary stocks. I can think a couple off the top of my head. I don't want to name them because to offend anyone, but they do trade at like 70 to 100 times earnings and will go up, and we don't own them, and that can be challenging from that perspective. So we do tend to be disciplined buyers. At most, we'll pay basically 1 times growth on profit after tax or on an EBIT basis on a multiple, and we're looking for that to basically go to 2 times growth. We tend to avoid investing in any commodity sector in general. That being said, you can't ignore it because it will drive the valuation of the currency, it will drive trade flows.
Okay, so that is the perspective on markets. We are up 45 on the Nifty. Let's see. I mean, Ashwini's point of view is that something has changed for financials, and maybe things accelerate there on the downside, and that's a big part of the market. We take a very quick break, the first on the show. We come back. Sandeep J. Shah, Associate Director of Motilal Oswal Private Wealth Management, is with us on the other side. Okay, 45 on the Nifty, holding on. But the Midcap index has lost a bit more. I mean, 31 lower on the Midcap index, 19,741 is where things stand. SEBI has mandated mutual fund houses to disclose how much fund managers, directors of the asset management company and other key employees invest in their schemes through their personal funds. And this data has become an important parameter for investors to monitor. Sumaira is joining in right now to tell us who's got how much, in a way, skin in the game. Sumaira, take it away.
Thanks very much for that, Prashant. And that's true. Let me, in fact, begin by clarifying that it's not my research, but Outlook Asia Capital's Manoj Nagpal, who writes for Money Control, has actually done some very, very interesting research on how many fund managers actually have skin in the game, like you said. Topping the charts is, of course, one of the most conviction-driven fund managers, Prashant Jain. So check this out. The current value of his investment in the HDFC equity fund is nearly 34 crores, and that's just his own money, and that's not all. Prashant Jain also has money invested in other funds, 27 crores riding on the HDFC Balanced Advantage Fund. And talking about faith, Prashant is also invested in the HDFC Top 100 Fund, which is currently yielding him about 17 crores. Not bad, right? Well, there are others as well with plenty skin in the game. S. Narain and gang. Look at this. The 4 fund managers of the ICICI Pru Balanced Advantage Fund have a combined investment as of date of about 53 crores in this very fund. And S. Narain is not done. He, along with the 2 other fund managers, have added about 32 crores in the multi-asset fund, and another 14 crores is in the ICICI Pru Equity and Debt Fund. Next comes Nilesh Surana, and who hasn't heard his name, right? He has a personal investment of nearly 4.5 lakh crore rupees in the Mirai Asset Emerging Blue Chip Fund. Roshni Jain is another one, along with Anand Radhakrishnan of Franklin, who have together put in over 2.5 crores in the Focused Equity Fund. Aditya Birla Sun Life's S. Mohanty, he's added about 2.5 crores in the fund which he manages, which is the Equity Advantage Fund. And there are a few more, actually. So there's Kotak's Harsha Upadhyay, who has invested about 2 crores in the Standard Multi-Cap Fund, while S. Krishna Kumar, considered one of the best mid-cap stock pickers, seems to agree with the image perception that he has, because he's added over 1 crore into the mid-cap fund which he manages. Finally, Manish Gunwani has added 1 crore to the Reliance Growth Fund. So that was all about the fund managers themselves. But take a look at this. The AMC directors of the Motilal Multi-Cap 35 Fund, which has an AUM of roughly about 14,000 crores, well, they're talking skin in the game as well. The key they have about 400 odd crores which is invested. Now, talking about the DSP group, which includes some of the key employees, including the CEO, they seem to be big proponents of putting their money where their mouth is as well. They have big investments in the 3 funds, which are going to be flashing by for you as well. So, Prashant, and this is not the exhaustive link. There are lots more, and these are just some of the interesting ones which I've picked out.
Oh, very interesting, Sumaira. Just one point, though. So this is essentially the value of holdings by, of these people in the fund. As of a certain date, right? I mean, this is not This is not the amount which they put in. I mean, this is essentially the value of their investments as of a certain date, right? Just to,
that's absolutely correct. This is not the money which they had put in. This is what their investments are yielding as of now.
As of now. Okay. All right. Just getting that out of the way. Sumaira, thanks very much. Sumaira will be back here on the anchor desk in just a bit. But let's take that conversation forward. Sandeep J. Shah is joining in. He's Associate Director of Motilal Oswal Private Wealth Management. He's joining in from the sidelines of the 14th Annual Global Investor Conference. Sandeep, thanks very much. Talking about putting your money where your mouth is. Any thoughts? I'm sure you heard Sumaira.
Oh, absolutely. I think this is an excellent piece of disclosure which SEBI has started, and it's really heartwarming to see that so many of the fund managers have put their money where their mouth is or where their investments are. And this will actually gives a vote of confidence to a lot of these funds. I think it's a trend which I hope will continue, and I see more of actually fund managers putting a larger and larger proportion of their net worth into their own funds. Of course, this is just another indicator that you would use for evaluating mutual funds or other schemes, investment ideas. It of course cannot be the sole criteria, but it's a very important and a useful criteria for evaluating skin in the game. And I hope that this only gains momentum.
Fair enough. Sandeep, so at the conference, what's the mood like? What are you picking up? What are the big questions being asked? And what are the answers being given?
Okay. Well, the mood certainly is extremely upbeat and optimistic. We've had a very good earnings quarter. We had, Nifty companies reported a 22% top-line growth. Of course, albeit on a low base because of GST last year. I find that I think really the question that investors are asking is, in terms of the cyclical recovery and the fact that even if you look at the performance, it's largely been consumption which is really driving earnings as well as even stock price performance. It hasn't been so much of your domestic cyclicals, or it hasn't really been as much as your infrastructure or other sectors. So investors are actually trying to understand whether this economic recovery can be more broad-based, whether more sectors can participate. Of course, even in some of the cyclical sectors like cement, the volume growth has been strong. But what has been happening is that there has been margin pressure because commodity prices had increased last quarter. So the outlook is to actually try and understand whether in things like infrastructure, capital goods, and a lot of other sectors, whether you would start seeing momentum. And of course, on the consumption side, to see how robust the growth is, how strong rural growth can continue to be. We've already seen that, especially on the FMCG side, that rural growth has outstripped urban growth for more than 4 quarters now. And I think the response that we've been hearing from most managements has been very optimistic. It's been quite positive. I don't find that either investors or certainly not the companies are really so concerned about who's going to come and win the next elections, because I think there's also a sense that whatever reform this government has done in these last 4 years, whichever government comes into place will actually reap the benefits of this long-term reform. So that's been the mood. The mood is positive. There is a lot of interest. I think people are willing to look at newer companies. I think there's also interest in some of the small and mid-sized companies because the stock prices have become very attractive. So there continues to be both interest in consumption and it's also increasing interest in the domestic cyclicals sectors of the economy.
Hi, Sandeep. Good afternoon. You spoke about, whether or not the reforms by the government can be carried forward. Does that remain the biggest variable, therefore, in terms of, what investors might be worried about? Is it more global in nature, their fears about what might derail the market? Is it more about whether growth will normalize or not? What remains the biggest fear in the market?
Well, I think if you were to look at the global picture, there are concerns that globally growth may be peaking out. Even though US remains the single most battle engine, if you please, for world growth, and that continues to be very strong. We see that, you know, Europe, Japan, and even China to some extent is showing some weakening there of growth there. At the same point of time, I would like to add that if you were to look at the liquidity picture, even if the Federal Reserve has reduced its balance sheet size by about, say, $140 billion over the last few months, you find that, you know, both in EU and Japan, you're continuing to seeing quantitative easing, and China is also loosening. So liquidity in that sense is quite strong and is in that sense partly offsetting concerns that whether globally growth is peaking out, especially if you look at commodity prices as one indicator. On the other hand, of course, you find that emerging markets haven't done as well or have been underperforming. In this context, you know, India obviously stands out. And what was an extremely narrow market, say about a month back or a month and a half back, well, is getting a little broader, perhaps not as broad as we would like it to be, but it's certainly getting a lot broader than it used to be. And in that sense, I think investors, we had seen a fairly largish sell-off in small and mid caps, and companies that are reporting good results, good quarterly numbers. Those companies are certainly finding that there are a lot of investors who are looking to buy into those names. And but of course, it's also important to remember that the small cap index was up 60% in 2017 and was down 22% from the peak and is now bouncing back. So, but coming back to the question of reform, I think clearly reforms in India are irreversible. We all know that now. I don't think anybody really argues about that. Secondly, the point I was really making was that this government has made a lot of reform which is long-term structural in nature. The benefits of which will come out, we'll really see over the next 5 to 10 years. So while there would, you know, on the one hand, the market is hitting a new high, suggesting that smart investors are pricing in a higher probability of the current government coming back, the majority of investors, especially on the retail or HNI side, tend to be a little more skeptical. So this actually partly explains the kind of market where we have, where a few stocks are leading and the rest have not been participating as much, which is reflected by the investor sentiment itself. So, but most investors aren't really worried, especially on the investors at this conference as well, about the government. While there are some concerns, it's just that it's a question of, you know, whether they will need outside support, whether they will be the largest party, or whether they will get it on their own. So while it's a concern, it's not something that's really impacting their decision today.
Sandeep, it's a pleasure. Thanks very much. Continue to have a good conference. Thank you very much for your time here on CNBCTV18 today. We slip into a very quick break here. We'll come back. We'll get you more on markets, specific stocks which are moving around. For now, it's looking actually better than when we started at 130, 51, 52 points in the Nifty. Take a break. Be right back.
Hi, welcome back. You're watching the Midcap Radar. Well, let's shift focus now to Page Industries, because that's been one of the big winners. In fact, Mangalam is here to analyze the company's journey since the time of its IPO in 2007. And aptly, Mangalam has called it the Centurion. Mangalam.
At the races, they say you don't bet on the horse, you bet on the jockey. And if one did bet on the jockey in the IPO in 2007, then they would have made returns of over 100 times. Page Industries, the stock price crossed the 36,000 mark in today's trading session. That means it's 100 times over its issue price of 360 rupees. Remember, the company was offered at a band of 360 to 395. Not much takers then. In fact, when it listed, it ended lower at 280 rupees. Ever since, the stock has moved about 100 times. So 15 shares was the minimum lot size. It had one bought there and applied and held on. That 5,400 rupee jockey would have actually been a Savile Row suit at 5,40,000 rupees itself. But it's not just the share price which has moved 100 times. It's also the company's financials. The revenue has grown 17 times, the margins have expanded, and the net profit has actually grown 21 times itself. So a trip down jockey's memory lane. So if you take a look at their revenues, it was at around 150 odd crores in FY7. In 1997, it was around 7 crores itself. So a 300 times return from 1997 to 2018 and a 30% CAGR over the last 11 years. Similar is the case for their EBITDA as well, just about 27 crores, and that one's moved to 541 crores. And the net profit, that one on the back of strong margin expansion and revenue growth, has grown at a CAGR of 32%. The stock, not cheap at all, trades at 68 times FY20 earnings. Most would argue that it is expensive, but many would also say that for the kind of brand strength that it has, the kind of distribution that it has, and a 10-year average ROE of 50%, some would say these valuations are justified. The management joined us. They said that going forward, the triggers, one would be tapping into women's wear, leisure wear, as well as the Speedo business, which they're growing, currently a small part of their business, but they do enjoy a high market share out there. Also, going forward, what we will watch out for is the company's guidance, revenue growth of 20% for 20 years. Also, the ROEs, they should not go below 50% is what the management says, with a margin between 21 to 22%. I remember interviewing Mr. Ginomal, and he said our biggest competition is ourselves. So that is Page's 100 times journey.
Interesting numbers, Bangalam. Thanks very much for that. So that's Page Industries. We're going to take a quick break, and we're going to thank you for watching Midcap Radar, but we're also going to leave you with some market opinion that we got through the course of the day. Atul Suri, CEO of Marathon Trends, PMS, we spoke with him earlier. He sees the bull market carrying on for another 2 to 3 years at least. Listen in.
The last 1,000 points have really taken most people by surprise. You know, we were coming out of a 6-month, very difficult market, and where a lot of the mid-cap, small-cap indexes were down 20–30%. So people are really surprised, and they're really looking for these reasons, you know. So I really think that one must have a belief in the longer-term trend that we are in this market, and one must not really wait for the perfect situation, perfect correction that at which stage I'll deploy. You must get into this market. Yes, it's run up a lot. Yes, it will correct. But the thing is that you have to look beyond these short-term cycles and ultimately be allocated to equities, because I still feel that we are part of a larger bull market, which I think will carry on for the next 2 to 3 years. The market, the leadership has changed. There has been a sectorial change. So a lot of people again find themselves in stocks, spaces, which the market is doing a lot, but it's not much happening. And you will have to bite the bullet and ultimately be fierce enough to really exit out of these positions and get into new sectors. I'm not speaking of 1 week, 1 day, 1 month. I'm speaking on a multi-year trend. So this fresh round, this 1,000-point rally has thrown up new sectors. It's very easy for us to see what they are. It's very evident already on the screen. But the difficult part is to be able to exit those that are not performing